So an event in the market that we've been paying very close attention to since last fall is the turnover from the growth style of investing to the value style of investing leading the way. Over the course of the last really 8 to 10 years, the value style has really significantly lagged the growth style. So let me just define those two styles really quickly. The growth style of investing is investing in companies that are growing faster than the average company, whether it be because they have a new product, whether it be because they're taking market share away from one of their competitors. It really doesn't matter what makes them a growth company. It's at the end of the day, they're growing faster than the average company out there. Over the course of the last 10 years, there's been an acronym that's developed related to these growth companies called FANG, and that's Facebook, Apple, Amazon, Google, and Netflix are the companies that make up the quote-unquote FANG stocks. They're great companies. They've been growing very rapidly, but they've also been companies that have really led the way in terms of performance. And the value stocks, the stocks that you would think about, I always use the old term, the Kmart Blue Light Special stock, the stock that is on sale out in the marketplace because something may be going on with a company that has led the stock price down. Even though the company is perfectly fine, it's healthy, it's just a little out of favor with the market, those stocks have really been left behind. To the tune that over the course of the last 10 years, the difference between growth and value on a portfolio could be almost literally 100%. So if you had $100,000 invested in value, you might have, and these are not real numbers by the way, you might have turned that into 200,000, but a growth investor might have turned their 100,000 into $400,000. So it's a very big difference in performance over the course of the last 10 years. However, one of the potential impacts or maybe even benefits of the coronavirus is that some of the value stocks got so beat up that now they're starting to lead the charge in the market. Starting about September 1st of last year, we've seen a lot of the really good growth companies start to stall out in the advancement of their stock price. And you're starting to see the return of the value stocks. The energy sector, for instance, the financial institutions are all starting to perform very well and really have been outperforming the growth stocks over the course of the last 6 to 9 months or so. Now, as an investor, why do I look at that and say that's a good thing? The simple reason is ultimately we have a much healthier stock market when more stocks are performing. For the last 8 to 10 years, in particular the last 4 or 5 years, the performance has been very concentrated in a very small number of stocks. Yes, it looked like the S&P index was doing well, and it was, but the performance was very concentrated at the largest 5 to 10 stocks. They were really leading the way and having a very heavy influence on the performance of that index. We have a much healthier environment when the other 490 stocks in the S&P 500 are all performing equally as well. It means that all of corporate America is doing well. So we've been watching this very closely. As most of our clients know, or as all of our clients probably know, we tend to be value investors. We're not looking to necessarily chase the next great growth stock from the time of infancy. We're trying to really buy the value stock that offers us a lot of protection on the downside, that generates a lot of really good cash flow, that has a low level of debt, that ultimately at the end of the day gives us protection in a bad market, but also gives us good returns because year over year they produce growth. They produce profits that grow. Maybe not as fast as the growth companies, but they still grow. So the last 6 months has been a very rewarding time for our clients. We're starting to see the portfolios turn over, or the performance turnover, so that the value stocks are now really leading the way. And by the way, a lot of those stocks are extremely cheap versus some of the growth stocks that you would look at and say, I'm not sure that's necessarily the best place to put my money because they do look a little overvalued when you look at them on a price to earnings basis or a price to sales basis or price to book value basis. A lot of those stocks are trading at relative valuations that are all-time highs. So that's something we'll be watching very closely over the course of the next 12 to 18 months. When a style leads the way, it usually leads the way for a multi-year time period, usually 4 to 5 to 8 years. Growth has been that leader since the financial crisis, going back to 2008 and 9. If value starts to gain leadership, we could see a 4, 5, 8-year time period where value becomes the leading play in the market. And that would be, I think, a very good, healthy thing for the markets to see.